So what happens when you miss the best days of the market? What does that math look like? Do you have any idea? I'm going to try to give you an idea of kind of what happens in here and how that relates to missing the best days of the market. They're often clustered together with the worst days of the market. And so our natural reaction is to look at it and go, I'm glad I got out. And then we doubt getting back in. And we miss the best days because, well, we've seen it here recently. There's been a great deal of volatility. No question, there's plenty to talk about. There's plenty of differences of opinion. There's all sorts of earnings coming out on a regular basis. And is the market too high? Is it not high enough? Are there particular sectors that have gotten too high? All of those things make us question what it is we're doing. We naturally do that. It happens up here. It happens between our ears. Here's the issue. It's normal. It's completely normal. And it's not about timing the market. It's about time in the market. And it's about understanding why we're in the market and what our values are, what our goals are, and how really coming to grips with the fact that volatility often can mean great opportunity. If you're doing regular investing and we happen to be down for a couple weeks and that's when your 401k invests, guess what? A little dollar cost averaging kicks in there. Never hurts to buy securities you really like, but at a lower price. And the same is true when it's going up and we're catching a trend and momentum is happening. And okay, we're happy to have paid X for it and we're glad to see it go to X plus 1. It doesn't necessarily mean that it's run its full steam. And if we like what we're investing in, typically we're talking about the long term. And so what actually gets in the way of missing those great days in the market? The first thing is panic selling. And so here we look at this and we read the headline or we hear the commentator saying the market is off whatever indice, is off X number of hundreds of points today. And we actually equate those hundreds of points to what it was, say, for example, years ago, which may have been a significant amount. But in today's term, with where the indices are tracking, it's not really. But we go back to what we know, which is our touchstone, which is what we kind of grew up with. And so we go there and we go, well, it must be a big deal. And so we panic sell. We say, boy, oh boy, I must be missing it because look how much whatever security has gone up. And so I'm doing this performance chasing. I'm trying to chase the cheetah that's already long since gone on the Serengeti and is chasing after something else. We may or may not catch a very attractive security, but at the same point in time, we may catch it where it's already done its run. So very, very difficult to do chasing of a security. We're all subject to poor timing. It just seems like, I had one client recently, they said, my goodness, so we're buying this and it just seems to go down that same day. So they pull it up the next day to say, what did we buy or how much of that did we buy? And it's gone down just a little bit. And so what happens? We go back to the first problem of panic selling, like we're now down X number of dollars in a day or in a week. Oh, did we make the right choice? And the reality of it is, if we're trading, well, that's really not what we're doing. There are people that get to lose a lot of money doing day trading, so we're not even going to go there. The last one is this belief that what I'm seeing can't be happening based on what I saw before. If your most recent memory is something where the market happens to be going down a little bit and it seems to have plateaued, but it's a lack of action because you say, well, I don't know, it just seems like it went down. But you're only watching it once every 2 or 3 months. But if you look at that over the long term, the trajectory has been up and to the right. Well, there's no guarantees that it's going to continue to do that. Nobody can give you that guarantee. But if you look at the long-term trends, if you look at the long-term, why are we doing what we're doing? Here's what happens. You actually begin to get a lot more comfortable and you're okay taking opportunities when opportunities present themselves. The reality of it is this. Volatility is not a loss. Volatility is just what the market does. Some days are more volatile than others. To bring this full circle, pun intended, what happens is that volatility actually oftentimes, if it's gone way up, can signal that now's the time where people retreat a little bit. But oftentimes that greater volatility, again, where we started this video, is very, very simple. The greatest days in the market, the most positive days in the market are often clustered to some of the most negative days in the market. Now, we can't necessarily time exactly what that looks like, but we can tell you it's about time in the market, not timing the market. Secondly, if we plan for the headlines and we talk about the headlines, we understand what's coming. They need to sell clicks or newspapers or magazines or subscriptions, whatever it is. I kind of chuckle to myself every morning when I pick up my computer or my phone, and I look at and I see this notion that, okay, so the futures market says this. Invariably, there's feature article, the first article in the news, and it says XYZ happened, so therefore people are concerned with this, or this is okay, so it's going to be a great day. They don't know. They just need people to click so that the advertising shows up on the side of your screen. If they knew that, they wouldn't have to write articles for an online publication of any kind. They'd be extremely wealthy. As a matter of fact, think of some of the wealthiest people we read about. They'd be wealthier than that if they were right. They're not. They're publishing articles because that's what they do. The last thing is, if you want to take a lot of the volatility out of the market, which really is about what's going on in here, know who you need to call. I am happy to have a full circle consultation with you, and one where we talk about kind of what it is you're trying to get accomplished and who's involved, your circle, and how does that impact them. Where is your framework looking at in terms of timing, in terms of your ability to handle some risk, and your understanding, well, who else is involved and what does that look like for them. But more importantly, if you like what you've seen so far, please click on subscribe. I'll do my very best to help investors like you. So why 88 milliseconds? It's actually hijacking your ability to think well, to think thoroughly, and to think completely through making better decisions. The problem that you may not realize is that 88 millisecond gap is the difference between reacting and reacting thoughtfully. That can make a huge difference in outcomes, not only in terms of total dollars amount potentially gained, but also in confidence and in understanding who you are and why things happen. And I discuss that in great detail in the next video, and I look forward to seeing you there.